What if the biggest stock market in the world is entering one of the most dangerous valuation zones in modern history? Right now, some analysts believe the US stock market may be as overheated as the dot-com bubble of the year 2000. And one of the strongest warning signals is coming from the famous Shiller CAPE ratio. At the same time, Warren Buffett has been increasing cash positions and reducing stock exposure. So the question is this another unstoppable bull market powered by artificial intelligence? Or are investors ignoring one of the biggest financial risks of this decade? In this presentation, we'll break down the CAPE ratio, Warren Buffett's recent moves, AI-driven market concentration, and what could happen next for investors. And before we continue, if you haven't watched our previous videos on uranium, copper, silver, and global trade choke points, check the cards above because all of these macroeconomic trends are deeply connected. Also, don't forget to subscribe, activate the notification bell, and leave a like because it really helps the channel grow. So what exactly is the Shiller CAPE ratio? The CAPE ratio, created by Nobel Prize-winning economist Robert Shiller, measures the stock market's valuation using inflation-adjusted average earnings over the past 10 years. Unlike a normal price-to-earnings ratio, the CAPE ratio smooths out short-term economic cycles. This makes it one of the most respected long-term valuation indicators in financial history. Historically, extremely high CAPE levels have often appeared before major market crashes or long periods of weak returns. That's why investors around the world closely monitor this indicator. Right now, the Shiller CAPE ratio has reached approximately 42. That is an extremely elevated level by historical standards. In the past 150 years, the market has only reached similar levels during the dot-com bubble around the year 2000. This does not automatically mean a crash will happen tomorrow, but historically, entering markets at these valuation levels has often produced weak long-term returns. Some analysts believe investors today are paying extremely high prices for future growth expectations, especially in artificial intelligence and mega-cap technology stocks. What do you think? Do you believe the market is entering dangerous bubble territory? Let me know in the comments below. One reason investors are paying attention to these warnings is Warren Buffett's recent behavior. Buffett has significantly increased Berkshire Hathaway's cash position. At the same time, he has reduced exposure to several stocks. Now, of course, Buffett's decisions do not guarantee a market crash. But historically, investors closely watch Buffett because of his long-term discipline and focus on valuation. When one of the greatest investors in history becomes more defensive, markets pay attention. This raises an important question. Is Buffett simply being cautious, or does he see risks many investors are ignoring? Another major concern is market concentration. A large portion of recent market gains has come from only a handful of giant technology companies. Companies like Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, and Tesla. Many investors believe artificial intelligence could transform the global economy, and that optimism has pushed AI-related stocks dramatically higher. But without these few mega-cap companies, the broader market looks significantly weaker. Some analysts believe the remaining 493 companies inside the S&P 500 resemble conditions seen during previous bubbles. If you enjoy this type of macro investing analysis, don't forget to like the video and subscribe because we regularly cover global trends, AI, energy, commodities, and financial markets. One of the most serious warning signs today is the negative equity risk premium. In simple terms, investors are no longer receiving attractive compensation for taking stock market risk. Government bond yields have become competitive compared to stock earnings yields. Historically, investors expected higher long-term returns from stocks because of their higher risk. But when that extra reward disappears, market valuations can become vulnerable. This is one reason why some economists believe future market returns may remain weaker over the next decade. So what happens next? Nobody knows with certainty. The The market could experience a major correction, or valuations could remain elevated for years because of AI optimism and liquidity. History shows that bubbles can last longer than many investors expect, but history also shows that extreme valuations eventually matter. That's why risk management, diversification, and emotional discipline are extremely important for long-term investors. What do you think happens next? A crash? A correction? Or another massive AI-driven rally? Comment below because I'd really like to hear your opinion. From a technical analysis perspective, these are some of the most important support and resistance zones currently visible on the S&P 500 weekly chart. Right now, the market remains in a strong bullish structure, but price is also approaching historically sensitive valuation and resistance areas. On the upside, the major resistance levels we are watching are 7,570, 7,710, 7,990, and eventually the higher zones around 8,270 and 8,860. If bullish momentum continues and liquidity remains strong, the market could attempt to push toward these higher targets. However, investors should also pay close attention to the downside support zones. The most important support levels currently appear around 7,430, 7,290, 7,030, and the broader support range between 6,640 and 6,380. A break below major support levels could increase volatility and potentially shift market sentiment much faster. It's also important to remember that technical levels are not exact numbers. They are zones where buyers and sellers often react emotionally and institutionally. And especially in highly valued markets, risk management becomes far more important than prediction. By the way, if you enjoy this combination of macroeconomics and technical analysis, don't forget to subscribe, activate the notification bell, and let me know in the comments if you want more market structure and S&P 500 analysis videos. Thank you for watching this presentation all the way to the end. If you found this analysis useful, make sure to subscribe, activate the notification bell, and leave a like because it really supports the channel. And if you want more videos about global markets, investing, AI, commodities, energy, and macroeconomics, let me know in the comments. Also, check out our videos on uranium, silver, copper, and global trade choke points because many of these global trends are deeply connected. And finally, remember that this presentation is for educational and informational purposes only and should not be considered financial advice. Financial markets always involve risk. Always do your own research and risk management before making investment decisions. Thank you again for your support, and until the next video, protect your capital.